Welcome to Tax Chats. This is Scott Dyring. I'm a professor at Duke University and happy to be with you today. I'm joined by Jeff Hoops, my colleague at UNC, tax expert and what should we say, founder of the UNC Tax Museum, which you can see behind him there. So it's great to have you here and thanks for joining. Today, we're going to talk a little bit about cryptocurrency and taxes. And one thing that I'm sure you all are aware of is there's really nothing in the world that taxes don't touch in one way or another, which is why I love to think about them. Cryptocurrency is no different. So we probably need just a little bit of a background just to kind of kick things off. So we're not going to spend much time talking about exactly what is cryptocurrency. If you want to, dig into the details of blockchain technology and so forth, there's plenty to read around on those details. But what does matter is whenever there's a thing that exists, the government tends to either tax it or maybe chooses to not tax that thing. And cryptocurrency is sort of an interesting case for trying to decide how it should be taxed, because at one level, it might be treated like currency, like dollars, in which case the tax ramifications would be very different than if it's treated like property, like buying and selling property. And let me just give like a very brief example of why that might matter. So if you have dollars and you want to use those dollars and exchange those dollars for something that you want, say, for example, a candy bar, when you exchange your dollar for the candy bar, there's not a tax on the gain or loss built into the value of your dollar. So say, for example, if there's inflation and your dollar becomes worth less, that might be a loss on your dollar. Or if there's deflation, your dollar becomes more or something, whatever it is. So there's not gain or loss built into the value of your dollar when you exchange that dollar for a candy bar. Contrast that with property. Suppose you want to sell something that you own, say, for example, a piece of land, and then buy something with the proceeds from that land. You have to pay tax on the gain built in your land, and then you would take whatever's left, and then you would go buy the thing. Well, if you use crypto to purchase something, because the IRS has designated crypto as property, you have to pay tax on the gain built in your crypto when you use it to buy something. Now, you might not realize this when you actually buy the thing, but at some point you have to say, okay, my crypto was worth X amount more than when I bought the crypto. And so I'm now going to exchange the crypto for a Tesla or whatever it is you want to buy with your crypto. And it turns out you need to pay tax on the gain in your crypto before you can buy the car. Actually, you don't even have to do it before. You could use the crypto and buy the car. But at the end of the year, when you're figuring out how much tax you have to pay, you should, in theory, figure out how much gain there was on the crypto and you pay tax on your crypto. But if you bought the car with dollars, you wouldn't have to do that. So that difference turns out to play an important role in some of the articles that we sent you, which is that you might be able to use crypto as a way to hedge your taxes in some ways. But it also creates lots of frictions when it comes to using crypto as a perfect substitute for more traditional currencies like the dollar. What have I missed, Jeff? Did I cover the basics there?
You did cover the basics. I think one important thing is you mentioned when you exchange the property, you said you're going to sell the property and buy something else with the cash. It would apply even if you just took one property and bartered with another property, right? If I trade something for something else, unless I do it in a very, very, very specific way, I still pay taxes.
Yeah.
So even barter transaction, I mean, you can't say, well, I never sold the crypto. There's never cash involved. It was just a barter. So maybe that's not taxable. No, if you exchange one asset for another asset, unless you do, it's very, very specific thing, then you're going to end up paying taxes even on that barter transaction.
Yeah. So if I trade my land for your amazing truck in some kind of a sale,
Yep.
there would be taxes on the gain in my land.
Yep.
Now, it is possible what you're talking about, I think, in the specific way, there's these things called 1031 like kind exchanges, and specific rules apply. And under some circumstances, you can defer the tax. It still exists. You just defer paying the tax until a later date. But that's obviously not the topic of today.
And then kind of a very little thing is we have a question in the chat box that says, like, what if, what about a foreign currency? We don't think of cryptocurrency as a dollar, but what if we thought about it like as the currency of another nation? And so if you're like a currency exchanger, I mean, you like trade foreign currencies, there are taxes on just trading foreign currencies. But for example, if I went to the UK 4 years ago and exchanged dollars for pounds, and I have those pounds in my wallet, and I went and bought something with those pounds today, I mean, I might be able to buy like a lot more stuff if the currency translation rates worked in my favor. And currently the US tax code wouldn't make that taxable as far as I understand, if I'm just using those pounds to buy goods.
But let's make sure we clarify that, because if I'm a currency trader and what I do is I buy and sell currencies for profit, then there will be taxes.
Yeah, but if I'm just buying currency and I just use it to buy stuff like a normal person, then there, as far as I know, are not taxes involved with this. So, but with crypto, that's not the case. If I buy crypto 3 years ago and use it at overstock.com, which accepts crypto, or buy silver bullion with it, or buy a Tesla with it, or buy whatever other thing I'm allowed to buy with crypto, you do have to pay taxes. And it's a pretty big friction. I mean, I think in the like Bitcoin world, what they really want is for not only Bitcoin, just crypto in general, is they want crypto to be able to use as a currency. And if every single time you use it, it's a taxable transaction that not only makes you owe tax, but also makes you have to keep track of tax, which is like this administrative burden of reporting and figuring out your gain and loss and what inventory system you're going to use for your crypto. Is it FIFO or LIFO or HIFO? Like, it gets really complicated, and it kind of precludes it being used as a normal currency, which I think some people would say is just like an unfortunate accident that we decided to tax it in that way. And isn't that so bad for the crypto world? I think a lot of people would say that was like quite intentional, that we decided to tax it in a way that would not allow it to be used as a currency nearly as easily, because some people in the government got a real thing against cryptocurrency.
Okay, so big kind of negative side to crypto is this idea that if you are really using it and you really actually want to obey the tax laws and avoid the possibility of an audit and detection, you really need to keep track of your basis. Whenever you use the crypto, you got to think of it as selling the crypto and pay tax on the gain and so forth. But there's also an advantage to this, which is you might end up having losses in your crypto. Crypto goes up, crypto goes down, usually a whole bunch every single day, it seems like. I don't own any crypto. I did buy some Coinbase stock, which mirrors at some level the rise and fall of crypto, and I seem to own it only when it went down. Pretty amazing investment of mine. But if you buy crypto, it's very volatile. So when the crypto value goes down, one might think to themselves, maybe I should sell that and lock in a loss, which one could do easily. But then the next temptation might be, maybe I want to retain the exposure to crypto. So why don't I sell it today and lock in the loss and just buy it again tomorrow, or maybe not even tomorrow, just buy it again 10 minutes later or something like that. That one can do that. That's no problem. People also might be tempted to do the same thing with like stocks. So if I own Coinbase stock and the stock goes down, I might think, yeah, I still like Coinbase, but it sure would be nice to have losses so that I can offset other profits with in my tax, offset some other profits in my portfolio to lower my tax bill. So maybe what I'll do is I'll sell Coinbase today and buy Coinbase tomorrow, just simply so that I can reduce my taxes. And it turns out that the government doesn't like that when it comes to
They're one step ahead of you, those clever devils.
They're one step ahead. They always are, the bandits. So the government says, if you buy a substantially similar asset within 30 days of a sale of that asset, either 30 days before or 30 days after, the losses that you incur cannot be used to reduce your taxes. Now, of course, the government being eager to what would you say, collect taxes, the gains you incur if you do such a thing are taxable, but the losses cannot be used to offset taxes. So in other words, you can't sell a stock, lock in the loss, and buy the same stock the next day. That's called a wash sale. And the wash sale rules prohibit this kind of thing from happening. Otherwise, people would just be buying and selling purely for a tax play. The government doesn't like that, so they say, no can do. But it turns out that those rules apply to securities like stocks and so forth, right? They also apply to contracts to purchase securities like futures, options, that kind of thing. So one might say, okay, fine, what I'll do is I'll sell my shares today and then I'll just buy an option to purchase the same thing in 30 days so I can get around this 30-day rule. But the rules will say, no, you can't do that, because we have included in the definition of this, if purchasing a contract to buy a security in the future. But lucky us, at least as insofar as we are currently aware, the definition of cryptocurrency does not apply. And so it's possible that, and many people believe right now, that you can, in fact, sell your crypto today, lock in the loss, buy crypto tomorrow, the same currency, and you now have locked in this loss, which will be, because it's property, it will be a capital loss. And if you've held it for more than a year, it would be like a long-term capital loss, and you might be able to use your long-term capital loss to offset other long-term capital gains that you have in your portfolio. If it's a short-term loss, likewise. And you can use it to offset up to $3,000 of ordinary loss if you have capital loss, right?
Ordinary income.
Or ordinary income, sorry. You can use it to offset up to $3,000 of ordinary income with your capital loss. So there are some people who are advising clients, or I don't know if it's clients, but there's some people who believe that an excellent tax strategy is to buy crypto, sell on the downswings, buy on the upswings, and lock in those losses without exposing yourself to significant amounts of risk. Use those losses to offset the gains in your other portfolios, in your portfolio, and you'll be better off from a tax point of view. Will it work, Jeff?
Well, so again, a few things to add. I mean, will it work? It depends on what you want it to work for. But when you say not subject yourself to risk, what you mean is not subject yourself to the risk of not owning crypto for those 30 days.
That's
so
correct.
The wash sale rule, like, want to impose the risk of owning the stock on you. And so, you have to, you can't just like sell and rebuy. So it's not as if this is riskless. It's, you don't miss out on the gains that will happen in those 30 days from crypto. I think one thing about this thing is super important. I mean, and you said it several times, but just to highlight the fact, we don't actually know if this is legal or not. We suspect it is. Following the case law, it is. As far as we know, there's been no court case where the IRS has audited somebody and said, you tax loss harvested, which is the term for doing this, crypto, and then rebought it within 30 days, and the wash sale rules apply. But they've never actually come out and said that, which is pretty fascinating. I mean, this is
so
actually,
what you're saying is, if you do this, we think it's okay, but nobody really knows for sure.
I mean, everybody and their dog is doing it, but we don't know for sure. And that is why right now, in at least some of the versions of this bill that the Democrats are trying to get through Congress with all the spending and all these new taxes, is to classify cryptocurrency as subject to the wash sale rules. So you might think they might just call it a security. They're not doing that because that is like opens up a whole new can of worms. And we can talk about that for like a long time. And they're not going to call it a security and make it subject to the crypto or to the watch sale rules. They're just going to like add another thing to the list of things subject to the watch sale rule, which includes cryptocurrency. I mean, I think in general, it's just fascinating how, Bitcoin itself kind of came out in 2009. It was 2014 before the IRS like came down and said what Scott started out with saying is this is a asset and not, this is a property and not currency. So there was 5 years that, I mean, you could kind of guess whether it was taxable or not in the way that it's currently taxable, but you didn't really know. I don't know why, like, we have a tax system that relies on us just like guessing for so long. This is not like a small little tiny niche product that isn't very much money. There's a lot of the crypto floating around, like crazy amounts of gains, and yet we're just subject to this uncertainty that we don't really know what the law is. So back to your point of like, does it work or not? I mean, the whole point of tax loss harvesting, you have to remember when you sell, you get that loss, but you've also reduced your basis. Meaning when you turn around and sell the crypto, you're going to pay a larger gain. So the only kind of real benefit of tax loss harvesting, and it is a big benefit, I mean, it's not to trivialize it, but it's basically to get the loss sooner than you would have otherwise got it. So it's like a time value of money play. And so to the extent that you're owning crypto already, and to the extent that there's not like a large cost to reshuffling your portfolio and selling and buying, then it's going to work. I mean, and assuming a positive time value of money, then it's going to work, and you're going to be on an after-tax basis better off if you tax loss harvest your crypto and rebuy it immediately.
Okay, so it would work if there isn't a change in the definition of the things that are subject to wash sale rules. And
if they change it, you're still fine because like they're very unlikely to say, and that was also the way for the last 5 years. But they could also just decide, well, I think it's unlikely that they decide that it was subject to the wash sale rules all along. That would be a pretty big deal and like a crazy lot of enforcement, but there's nothing keeping that from happening.
Yeah. Okay, so let's just talk in general about enforcement and crypto. So we often hear about crypto as being the thing of choice for criminals. Everybody wants to hide everything using crypto. There's a fascinating book called An American Kingpin, which describes the creation of the dark web, the Amazon of the dark web, which was called the Silk Road, and all of the transactions took place using, I think, Bitcoin. Many people believe that this was only possible because one could transact on the dark web more or less anonymously yet securely with these virtual currencies and so forth. At the same time, crypto is kind of secret, but it's kind of like not secret because there's like an audit trail that goes along with like every single transaction. And so sometimes we think of it as like being this amazing anonymous thing that exists that allows people to transact, but in some ways it's actually less anonymous than any other thing that we know because there's this perfect digital trail of every single thing that happens. So the other, I guess, issue is some Coinbase trading is taking place on some crypto trading is taking place on platforms like Coinbase, but much of it is not. And so the IRS might have a much more difficult time figuring out who actually owes tax on crypto transactions than they might say with the sale of stocks and bonds, because the sales of stocks and bonds primarily take place through brokerage houses. The brokerage houses send information to the IRS, but the transaction of cryptocurrency, although Coinbase is a thing, much or maybe even most of cryptocurrency does not take place. Much of that cryptocurrency business does not take place through an exchange, and so the government doesn't get as much information. So I guess the question becomes, is crypto helping people evade taxes, or is it not that big of a deal? What is it, Jeff?
Yeah, I think that's a fascinating thing to think about, and I don't think we know at this point. I mean, I think early on, it definitely was helping people evade taxes, and evade. I mean, you can think about it in two different ways. Evade taxes, and like you are looking for some way to evade taxes. You go out, buy crypto, and you have this asset that nobody knows about, and you could think about it as like a tax haven. It's like a substitute for having a bank account in Switzerland or the Cayman Islands is to buy crypto. Alternatively, you could think about it as somebody who's just interested in crypto, trading crypto, and just decides, oh, like I have all these gains, I'm not going to pay taxes. So there's two different ways to think about tax evasion with crypto. And I think they are kind of substantively different as like an alternative to a tax haven, as opposed to just like you have all these gains and it's a little bit easier to not pay taxes. I think the ability to do that has diminished quite a bit over time, right? The IRS, for example, has changed their tax form to specifically ask about crypto. It's the only asset that the IRS asks everybody, like, did you buy something? Did you transact in something? We don't ask about that for anything else. That was added in 2020, I believe.
Hey, can I ask a question about that? So in 2019, I think they added it. In 2020, I think they moved it to a more prominent location.
Yep.
Do you think what they're doing is setting up future litigation so that they can say, so that taxpayers can't claim ignorance because this question was so prominently asked on the tax form?
I'm not sure. I mean, litigation is generally not a defense against these kinds of things. We're expected just to know, like,
you can't claim ignorance and say, I just didn't know.
I mean, people try. Sometimes it's a little bit successful, but nobody's like going to get out of a large cryptocurrency tax bill just because they didn't happen to know. But as I was saying, I think it is like a long-term strategy. The IRS is just clamping down harder and harder and harder. I mean, you mentioned Coinbase, this marketplace where you exchange Bitcoin. A while ago, there was what we call a John Doe summons from the IRS. Where the IRS just said, like, you need to just like give us all of your information, Coinbase, about who's transacting on Coinbase, and they got that information. They've since done that in other places that were much less public. So that first Coinbase John Doe summons was quite public. They've done it in other instances where it has been less public. So they're really working on trying to enforce this, but it's really hard. I mean, like Scott said,
if somebody's listening to this and you bought and sold currency, cryptocurrency on Coinbase, then it's very likely the government knows that you bought and sold crypto, right? And then if you choose to not pay tax on your gains and losses incurred while trading, and you did it through an exchange like Coinbase, you're going to very likely be known to the IRS. Now, whether they will come after you is a different question, but they will know. Is that true?
I think that's likely true. I mean, we think about like the audit lottery, as in like I can like not pay taxes or do something with my taxes, and the IRS will choose to audit me or not. It's important to realize that that's not like a random thing. Is like the IRS just decides to do that for some people and not for others. I mean, in some extent that is. But in cases where the IRS just has like a massive list of electronic records that they can match up against tax returns, they're just going to send a letter out to everybody, right? It's not like they're just going to randomly pick a few hundred people from the Coinbase John Doe summons and go after them. They're going to decide whether or not there's some basis for believing this taxpayer did not comply with the law and send out the audit letters to everybody. So that's a little bit of a thing with these exchanges, is that, you know, to the extent the IRS can get organized information about people, they're going to use it to enforce the law.
If let's just suppose, would it be possible at some point to create some tool that the IRS might have, which would allow it to perfectly track every Bitcoin transaction and make everything perfectly taxable, to almost like eliminate tax evasion in some ways? Is that like conceivable?
Well, so I mean, like you said, I personally can track every single Bitcoin transaction. So tracking every Bitcoin transaction is pretty trivial, right? You know exactly what every single wallet ID does every single millisecond of every single day with your Bitcoin holdings. The question is, can you, and this is really the only question, can you map a Bitcoin ID into a social security number? And that is sometimes not that hard, and sometimes it can be quite difficult. There are different, I mean, we keep on saying Bitcoin as if it was synonymous cryptocurrency. There's thousands of cryptocurrencies,
right,
which have like a huge variability in how secretive they are. You know, I've had discussions with the people at the FBI that like do this mapping, and the guy basically told me there that like every time he's really wanted to find an individual that's behind a wallet, he's been able to do it. But these are FBI agents chasing down like large amounts of money, or people who've like killed people, or like big things. when it comes to the IRS, at some point, you don't have the resources to find everybody who just owes a mere, a few tens of thousands of dollars on these wallets.
But so let's give it like a hypothetical. So you know how every year when the UNC Duke basketball game happens and we bet, okay, we make a like small little bet, and I usually end up winning. And Jeff and I meet in a parking lot and we make an exchange, okay? And that exchange usually takes place in the form either of cash or some kind of a lunch.
It's payment. A lunch, never cash, always right. Lunch.
Should be cash. If we make a lunch payment, or if we did it in cash, it'd be pretty hard for the IRS to find out that I had gambling winnings and should have paid tax on that. If instead we exchanged Bitcoin, maybe we should try that, by the way. Instead, we exchanged Bitcoin. If the IRS wanted, they could figure out that Bitcoin changed hands, and then they could go figure out what that transaction was about, and they could tax it if it was a taxable thing. Is that possible?
Again, if they can map a wallet ID into a social security number. I mean, this actually reminds me. You remember when we first set up Venmo account, Scott? Or when I set up my Venmo account, I tested mine by sending you $1, and I realized that this was all public, and I put the memo as something like payment for drugs.
Yeah.
just to like test out if anybody noticed that. I mean, yeah, the question is, can they map a wallet ID into an actual taxpayer? And I suppose they could create some law like some countries have done, either outlawing it or like making it so you have to like register to be able to buy Bitcoin. But then again, it's really hard to enforce that when the ability to buy Bitcoin really only has to do with you having like any electronic device, a phone or a computer, and it would be really hard to impose that rule and to enforce that rule. And a lot of people would say, if we think that blockchain and these kinds of currencies are the future, it's going to be a very backward-looking government that's going to like inhibit crypto innovation.
Well, I, for one, am hoping they don't do that, because I kind of like taking my gambling winnings from you tax-free. It reminds me a little bit of the sales and use tax, which most of you probably don't know, but most of you are probably sales and use tax evaders. If you ever buy something and you don't pay sales tax on it, you're legally obligated to report that thing to the government and pay the sales tax on it, even though the retailer did not collect it from you. And that was a bigger problem a few years ago when everything on the internet was being sold without the vendor collecting sales taxes. But it's sort of happening, right? And the day could come where every transaction is easily tracked because of Bitcoin. And it's much easier to kind of transact. Whereas with cash, just pure dollar bills, it can be really hard to track stuff, and it can be easy to evade, but it's not as easy to transact in some circumstances with actual dollar bills. And so I think that's why virtual currency has a lot of appeal in many circumstances.
Yeah. Okay. I think it's important, like what transactions, it's like things that involve large amounts of money, or that involve where you don't want the person to know where you are.
Yeah.
So if I'm like paying a kidnapper ransom to like get my child back, if I have to physically deliver cash, then I have to have an address to deliver it to, and that has some connection to the person. So it's not just like a random set of transactions where cash isn't any good for. It is the kinds of transactions that we don't like, that we might want to inhibit.
Yeah, very fascinating. All right, we're pretty much out of time. If anybody has any additional questions about how you can use crypto to reduce your tax bill, that would be tax loss harvesting or using the wash sale rules in your advantage, or any other questions about taxes and crypto, now's your chance to ask. I don't see any. I haven't seen any pop in on the chat. So thanks a lot for joining. We'll do it again next week, same time. And I'll send out an announcement so that you can be aware of what we're going to be discussing and take a look at articles. Talk to you later.